Hi there, you're watching a video about Ifrs 16 Leases. I am Senior Hannington, your tutor. Now we have created the CPA revision kits for paper 1, that is financial accounting, paper 2, quantitative techniques, paper 6, taxation, paper 7, that is cost and management accounting, financial reporting, paper 8, management decision and control, that is paper 11, advanced taxation, paper 9, financial management, paper 10, and advanced financial reporting, paper 13. Now these revision kits are enriched with the past paper questions and answers, and we prepared these kits basically to guide you in the preparation for your final CPA exams. Many students across the country have passed their CPA exams with the use of these revision kits. Therefore, there is no reason as to why you should not get yourself a copy. In today's session, we are going to look at Introduction to Leases, IFRS 16, the new leasing standard. Now, leasing transactions are extremely common. This is an important practical subject. Leasing is an important and widely used financing solution. It enables companies to access and use property, plant, and equipment without incurring large cash outflows. In fact, some companies look at leases as the only option which they can use to obtain the use of a physical asset without its purchase. So meaning that leasing transactions are very important. Now, when you look at the learning objectives, after this session, you should be able to explain the background of the new leasing standard, the objective of IFRS 16 leases, the scope of the standard. Then you should also be able to define what a lease is, the parties to a leasing agreement or leasing arrangement, determining whether an arrangement contains a lease. Then after that, I will apply the principles above using an exam scenario. Background. Now, IFRS 16 replaces the old IAS 17 leases. IFRS 16 came into effect on 1st January 2019, though it was issued way back in 2006 January. Now, the old standard IAS 17 closed many loopholes. However, it was also open to manipulations and abuse. Remember, in the old standard IAS 17, it classified leases as a finance and an operating lease, meaning that either you classify the lease as a finance lease or as an operating lease. Now, the classification of leases as a finance and an operating lease resulted into the manipulation of leasing transactions. You find that companies entered into leasing transactions which in reality are finance leases, whereby the company should recognize an asset as well as a liability, and the asset and the liability should appear on the face of the statement of financial position. But companies went ahead to classify these leases as operating leases. Remember, for an operating lease, there is no any asset as well as liability presented on the face of the statement of financial position, what we call off-balance sheet financing. So to solve all this, IASB had to introduce a new standard for leases, and that is IFRS 16. So the main reason as to why IFRS 16 was introduced was to completely eliminate off-balance sheet financing. Don't forget that IFRS 16 requires leases to recognize most leases to give rise to assets as well as liabilities, meaning that most leases are going to be recognized and presented in the financial statements, so you expect to see more assets and liabilities. Don't forget that the IASB issued this IFRS 16 as a joint project with the Financial Accounting Standards Board. Now, IFRS 16 is already in effect and it is applicable. Don't forget that. There is no more IAS 17 leases. The new applicable standard is IFRS 16 leases. Now, this session, of course, is more relevant and important to students of financial reporting and advanced financial reporting. The objective and scope of IFRS 16 leases. Now, the objective of IFRS 16 is to specify the principles for recognition, measurement, presentation, and disclosure of leases. What is the scope of IFRS 16 leases? Now, IFRS 16 leases applies to leases of all assets except for leases of non-regenerative resources. Talk about mineral resources, talk about natural gas, talk about oils, and other similar non-regenerative resources. This standard does not apply to leases of biological assets covered under IS 41. Talk about the service concession arrangements covered under IFRIC 12. Licenses of intellectual properties granted by lessors covered under IFRS 15. Revenue from contracts with customers. Rights held by a lessee. Optional exemptions. Now, lessees will have a single accounting model for all leases. However, there are two exemptions. That is low value assets and short-term leases, meaning that the accounting model under IFRS 16 does not apply to assets with a low value and short-term leases. A lease defined. We need to know what a lease is and then what are the parties to a leasing agreement. Now, a lease is a contract or a part of a contract that conveys the right to use an asset, asset for a period of time in exchange for a consideration. That is a lease according to IFRS 16, meaning that in this contract we see that there is the transfer of the rights to use an asset to one party, but in exchange for a consideration. So one party uses the asset, then the other party receives some cash inflows. Now, what are the parties to the leasing arrangement? Now, in the leasing arrangement, we have two parties. That is the lessor and the lessee. The lessor and the lessee. We look at the lessee as the user of an asset. Then we also look at the lessor as the legal owner of the asset or the supplier. Those are the two parties in a leasing arrangement. Now, how would we determine that a leasing arrangement contains a lease? How would we determine that a leasing arrangement contains a lease? Now, according to IFRS 16, to be a lease, a contract must convey the right to control the use of an identified asset. Of course, the identified asset could be a physically distinct asset, or it can be part of an identified asset, such as a floor of a building. So meaning that we look at the transfer, we look at the right of control, the use of the identified asset. Now, a contract conveys the right of control of an identified asset for a period of use if the customer has rights to substantially all the economic benefits from the use of the asset. Then still, if the customer has the right to direct the use of the asset, then the contract contains a lease. Meaning that if you're to determine if an arrangement contains a lease, there are three questions which you need to ask yourself. Do we have an identified asset? Does the customer have rights to substantially all the economic benefits from the use of the asset for a period of time? Is the customer having rights to direct the use of the identified asset? If the answer is yes for all the three questions, then the contract contains a lease. However, if the answer is no for all those three questions, then the contract does not contain a lease. Now, in this session, I'm going to put focus on how to determine if the contract contains a lease. I'm going to use an examination scenario to apply the above principles. This is our exam scenario. That while searching some invoices, the accountant found a contract which Calendar had entered into on 1st January 2007 with Diary, another entity. The contract allows Calendar to use a specific aircraft owned by Diary for a period of 3 years. Calendar is required to make annual lease payments. There are contractual restrictions concerning where the aircraft can fly. Subject to those restrictions, Calendar determines where and when the aircraft will fly, and the cargo and passengers which will be transported. Now, this is a scenario. We have two different parties, that is Calendar and Diary. We see that Calendar is going to use the aircraft, though this aircraft is legally owned by Diary. The period of use is a period of 3 years, meaning that this is not a short-term lease period because it exceeds the threshold of one financial year. So we see that Calendar uses the asset. So Calendar in this case is our lessee and Diary is the lessor. The lease term is a period of 3 years. Don't forget that Calendar is required to make annual lease payments for a period of 3 years. We see that there are some contractual restrictions concerning where the aircraft can fly, but subject to this, the thing is that Calendar determines where and when the aircraft will fly and the cargo and passengers which will be transported, meaning that Calendar has the right to direct the use of the asset. So Calendar can determine where and when the aircraft will fly, the cargo and the passengers which will be transported, meaning that Calendar has that right to direct the use of the asset. Diary is permitted to substitute the aircraft at any time during the 3-year period for an alternative model and must replace the aircraft if not working. Any substitute aircraft must meet strict interior and exterior specifications outlined in the contract. There are significant costs involved in outfitting an aircraft to meet Calendar's specifications. The accountant requires advice as to the correct accounting treatment of this contract. Required. Advise the accountant on the matter set out above with reference to IFRSs. Now, this is my analysis. As I have told you that we need to ask ourselves 3 questions. Is there an unidentified asset? Is calendar having rights to substantially all the economic benefits from the use of the asset for a period of 3 years? And is calendar having the right to direct the use of the aircraft? If yes, then the contract contains a lease. Now, according to the question, according to the scenario, we see that the answer is yes, because there is an unidentified aircraft, which is there is an unidentified asset, which is the aircraft. We see that calendar is going to obtain the economic benefits from the use of this asset for a period of 3 years, and calendar also has the rights to direct the use of the aircraft for a period of 3 years. So calendar has control. Calendar has control, meaning that in this scenario we have to apply IFRS 16 leases. We have to apply IFRS 16 leases. However, there are some legal and contractual restrictions which limit the aircraft use, but these protective rights only define the scope of calendar's right of use, but do not prevent it from having the rights to direct the use of the aircraft. Therefore, calendar has the right to use the aircraft during the 3 years in exchange for a consideration. Though they can substitute the aircraft for an alternative, the cost of doing so would be prohibitive because of the strict specifications outlined in the contract. Now, based on the above analysis, we see that the arrangement contains a lease, and calendar should apply IFRS 16 leases. In particular, they have to apply lease accounting. In the next session, of course, I will look at lease accounting. We see what is the required accounting in the books of calendar. But in this session, we wanted specifically to look at the new leasing standard, the scope of the standard, what a lease is and what are the parties to the leasing arrangement, and then how would we determine if a contract contains a lease. How would we determine if the contract contains a lease? And we have used our exam scenario to identify or determine when the contract contains a lease. As I have told you, that a contract contains a lease if that contract conveys the right of control for the use of the identified asset in exchange for consideration. And in this case, we see that calendar has the right of control of the aircraft. So that was a short summary about IFRS 16 leases. Now, IFRS 16, of course, has more details and specifications about the accounting for leases. It's a wide standard where you have to look at lease accounting. It covers lesser accounting as well as sale and leaseback transactions. Now, for more about leases, you can follow me on my blog address, that is huntingtonsolar.blogspot.com, for more information about leases. Bye and thanks for watching.